For most people, the silver market looks simple. Price goes up, price goes down, charts move, analysts argue, and investors react. On the surface, it appears to be a normal commodity market like oil, copper, or wheat. But beneath that surface is a structure that very few participants truly understand. And once you understand that structure, the idea of a free market for silver becomes much harder to defend. Silver is not just another commodity. It is a monetary metal with thousands of years of history, an industrial input critical to modern technology, and a financial instrument traded primarily through paper contracts, rather than physical exchange. These three roles collide inside a system that was never designed to allow true price discovery when stress appears. Instead, the system is designed to remain orderly, predictable, and most importantly, controllable. To understand why many analysts now talk about a kill switch in the silver market, we need to step back and examine how price is actually discovered, who participates in that process, and what happens when the price begins to move in ways that threaten the stability of the system itself. In theory, price discovery is simple. Buyers and sellers meet, supply meets demand, and price adjusts until equilibrium is found. But in modern financial markets, especially in precious metals, price discovery does not primarily occur where physical metal changes hands. It occurs in derivatives markets, specifically futures markets, where contracts representing silver are traded in volumes that dwarf the amount of real metal available. This is not an accident. Futures markets were originally designed to help producers and consumers hedge risk. A miner could lock in a price for future production. A manufacturer could lock in a price for future consumption. Over time, however, these markets evolved into speculative arenas dominated by financial institutions, hedge funds, and algorithmic traders. Physical delivery became the exception rather than the rule. Today, the vast majority of silver futures contracts are never settled with physical metal. They are rolled over, closed out, or settled in cash. Yet these contracts determine the global reference price for silver. This means the price you see quoted on your screen is not primarily the result of people buying and selling actual silver. It is the result of leveraged paper trading. This alone creates a disconnect, but the real issue begins when volatility enters the system. Volatility is dangerous in leveraged markets. When prices move too fast or too far, someone is on the wrong side of the trade, and losses can compound quickly. In silver, this is especially important because the market is relatively small compared to other commodities. It does not take enormous capital to move prices, especially during periods of thin liquidity. This is where control mechanisms enter the picture. Modern exchanges operate under strict rules designed to maintain orderly markets. These rules include margin requirements, position limits, and trading halts. On paper, these tools exist to protect the integrity of the market and prevent disorderly trading. In practice, they also act as brakes on price movement, especially when that movement becomes uncomfortable for large participants. The idea of a kill switch is not a conspiracy theory. It is a shorthand way of describing these control mechanisms when they are activated aggressively or asymmetrically. A kill switch does not mean someone presses a literal red button labeled Stop Silver. It means that the system has built-in ways to pause, slow, or reverse price discovery when certain thresholds are reached. One of the most important of these mechanisms is the trading halt. A trading halt occurs when price moves beyond predefined limits within a certain period. These limits are set by the exchange and are supposed to apply symmetrically to both upward and downward movements. In reality, the context in which halts occur matters more than the rulebook description. In silver, many of the most notable halts and interruptions in recent years have occurred during sharp upward moves rather than crashes. This is significant because rising prices stress short positions, while falling prices stress long positions. The silver market, historically, has been dominated by large, concentrated short positions held by a small number of institutions. When prices rise rapidly, these short positions face mounting losses. Margin calls increase. Liquidity becomes a problem. Under these conditions, allowing unrestricted price discovery becomes dangerous for the stability of the market as a whole. So the system intervenes. Intervention does not always look dramatic. Sometimes it is a halt. Sometimes it is a sudden increase in margin requirements. Sometimes it is a liquidity vacuum created by algorithmic withdrawal. The effect is the same. Momentum is broken, confidence is shaken, and price is redirected. This is why many investors notice a recurring pattern in silver. Strong rallies often stall abruptly. Breakouts fail. Key technical levels are approached and then violently rejected. To the casual observer, this looks like normal market behavior. To those who study market structure, it looks like control. It is important to be precise here. This is not about claiming that silver should be at some specific price. Markets do not owe anyone a particular outcome. This is about whether the process by which price is discovered is allowed to function freely. When a market is free, extreme moves are allowed to happen. They are painful, chaotic, and sometimes destructive, but they clear imbalances. In controlled markets, extreme moves are suppressed in favor of stability. The problem is that suppressed volatility does not disappear. It accumulates. Silver sits at the intersection of multiple stress points. On the supply side, mine production is constrained by geology, energy costs, and declining ore grades. On the demand side, silver is essential for electronics, solar panels, medical applications, and emerging technologies. Unlike gold, much of the silver consumed industrially is not easily recoverable. At the same time, silver retains its monetary role. It is accumulated by investors seeking protection against currency debasement, inflation, and systemic risk. This creates a unique dual demand structure. Industrial users need silver regardless of price, while investors want silver precisely because price is being distorted. This combination is inherently unstable. In a truly free market, rising demand and constrained supply would lead to sustained price increases. Those increases would ration demand, encourage new supply, and eventually restore balance. But when price signals are dampened by paper markets and control mechanisms, that balancing process is delayed. Instead of gradual adjustment, pressure builds beneath the surface. This is why the physical silver market often tells a different story than the futures price. Premiums rise, delivery times lengthen, inventories draw down, retail shortages appear even when the paper price remains subdued. These are signs of stress that do not always show up on a chart. The futures market, however, remains the dominant reference point. As long as the paper price is accepted as the price, the illusion of normality can persist. The kill switch concept becomes most relevant during moments when that illusion is threatened. When silver begins to move too quickly, especially upward, it signals that paper supply is being overwhelmed by demand. It suggests that participants are no longer willing to accept synthetic exposure and want either physical delivery or higher prices to compensate for risk. This is when control mechanisms become active. The stated justification is always the same: market stability, investor protection, orderly trading. These are reasonable goals on their own. The problem arises when stability becomes a substitute for truth. Price is information. It conveys scarcity, demand, risk, and confidence. When price is managed, information is distorted. Participants make decisions based on signals that no longer reflect underlying reality. Over time, this erodes trust. The silver market today operates in a strange dual state. On one hand, it is presented as a deep, liquid, globally traded market. On the other hand, it behaves like a tightly controlled system that cannot tolerate certain outcomes. This contradiction is not sustainable indefinitely. The reason the kill switch matters is not because it proves manipulation in a dramatic sense. It matters because it reveals the priorities of the system. When forced to choose between free price discovery and systemic stability, the system chooses stability every time. That choice has consequences. It means price moves are truncated. It means risk is transferred from institutions to the broader market. It means imbalances persist longer than they should. And it means that when adjustment finally occurs, it is more violent than it would have been otherwise. Silver is not unique in this regard, but it is one of the clearest examples because of its size, its dual role, and its history of volatility. Understanding this does not require believing in hidden cabals or secret meetings. It requires understanding incentives. Exchanges want orderly markets. Large participants want predictable outcomes. Regulators want stability. None of these goals align perfectly with free price discovery during periods of stress. The kill switch is simply the mechanism by which those priorities are enforced. In the next part, we will go deeper into the structure of the silver futures market itself. We will examine how leverage works, how paper volume compares to physical supply, and why this imbalance makes control not just possible, but necessary from the system's point of view. Because once you understand the mechanics, the behavior of the silver market stops looking mysterious and starts looking inevitable. Part 2. Inside the machine. How paper silver replaced real price discovery. To understand why the silver market behaves the way it does, we have to move past headlines and price charts and examine the internal mechanics of the system itself. Most investors focus on outcomes. Very few focus on structure. But in financial markets, structure determines behavior long before sentiment or fundamentals ever matter. The silver futures market is not a mirror of the physical silver market. It is a separate ecosystem with its own incentives, constraints, and failure points. Once you understand this, the idea that price is being managed stops sounding controversial and starts sounding logical. At the center of this system is leverage. Leverage is the defining characteristic of futures markets. When a trader buys a silver futures contract, they are not paying the full value of the silver represented by that contract. They are posting margin, a fraction of the total value, which gives them exposure to price movements. This allows large positions to be controlled with relatively small amounts of capital. In moderation, leverage improves liquidity and efficiency. In excess, it distorts reality. In the silver market, leverage is extreme. At various points in time, the total paper claims on silver represented by futures and related derivatives have exceeded annual global mine supply by many multiples. In some estimates, the ratio of paper silver to physical silver available for delivery has reached dozens to one. This means that for every ounce of real silver that could theoretically be delivered, there are many more ounces promised on paper. This structure only works as long as most participants do not demand delivery. The futures market is built on the assumption that contracts will be closed out financially. Delivery is treated as an edge case, not the norm. The system remains stable as long as confidence in cash settlement holds, and as long as participants believe that physical silver will be available if needed. Problems arise when that confidence is tested. One of the most misunderstood aspects of the silver market is the concept of open interest. Open interest represents the number of outstanding futures contracts that have not yet been closed or delivered. High open interest relative to available physical inventory is not automatically a problem, but it is a signal of leverage. When open interest grows while inventories stagnate or decline, the system becomes increasingly fragile. A relatively small increase in demand for physical delivery can stress the entire structure. This is where the role of large institutional participants becomes critical. A small number of banks and financial institutions dominate the silver futures market. These entities act as market makers, liquidity providers, and often as large short sellers. Their role is complex. On one hand, they facilitate trading and provide liquidity. On the other hand, their positions give them enormous influence over price behavior. Concentration matters. When a handful of entities control a significant portion of the short side of the market, price movements take on a different meaning. Rising prices do not simply reflect increased demand. They represent increasing stress on these concentrated positions. This is not a moral judgment. It is a structural reality. If prices rise gradually, positions can be adjusted, hedges can be placed, and risk can be managed. If prices rise rapidly, losses can spiral, margin requirements can explode, and systemic risk can emerge. The silver market has experienced this before. Historically, some of the most dramatic moves in silver have occurred when paper claims began to collide with physical constraints. These episodes are often remembered as speculative manias or anomalies, but they share a common feature. The system briefly lost its ability to suppress price discovery. Each time, the response has been similar. Rules are changed, margin requirements are raised, trading conditions are altered, the market is stabilized. From the system's perspective, this is success. From a free market perspective, it is intervention. Margin requirements are one of the most powerful tools in this process. When volatility increases, exchanges can raise the amount of capital required to hold a position. This disproportionately affects leveraged participants, especially those on the long side during a rally. Raising margins forces traders to either add capital or liquidate positions. In a rising market, this can abruptly reverse momentum. Even if the underlying demand remains strong, forced selling can overwhelm buyers in the short term. Importantly, margin changes are not neutral in their impact. Large institutions with deep capital reserves can absorb margin increases far more easily than smaller participants. This shifts the balance of power during periods of stress. Another critical element is the structure of delivery itself. Futures contracts are often assumed to represent a simple promise. Silver will be delivered at expiration. In reality, delivery is a tightly controlled process governed by exchange rules, approved warehouses, and specific forms of silver. Not all silver qualifies. Not all locations are acceptable. Not all participants are positioned to take delivery even if they want to. This creates friction. When demand for delivery increases, it does not automatically translate into physical metal changing hands. It triggers a negotiation within the system. Cash settlements, exchange for physical mechanisms, and alternative arrangements become more common. Again, this is not hidden. It is documented. But it fundamentally changes what a futures contract represents. Instead of being a straightforward claim on metal, it becomes a claim on a system's willingness to provide metal or an acceptable substitute. This distinction becomes crucial during stress events. If a sufficient number of participants were to demand delivery simultaneously, the system would face a choice: allow price to rise to levels that ration demand, or intervene to maintain order. History suggests the latter is preferred. This preference is encoded into the rules. Position limits are another example. In theory, position limits prevent any single participant from dominating the market. In practice, exemptions exist for certain classes of traders deemed to be providing liquidity or hedging. These exemptions allow large positions to persist under the justification of market function. The result is a market that is heavily skewed toward institutional participation and away from organic, physical trade. From the outside, the silver market looks liquid. Volume is high. Contracts trade constantly. But liquidity in paper does not equal liquidity in metal. These are two different things, often conflated. When confidence is high, the distinction does not matter. When confidence erodes, it becomes everything. This brings us back to the idea of the kill switch. The kill switch is not a single mechanism. It is the combined effect of leverage, margin rules, trading halts, delivery constraints, and concentrated positioning. Together, these elements form a system that can absorb shocks, but only by limiting certain outcomes. In particular, the system is highly sensitive to rapid upside price movement. Downside moves, while painful for long holders, tend to reduce stress on the system. They reduce margin pressure on shorts. They discourage delivery demands. They restore confidence in paper claims. As a result, downside volatility is often allowed to play out more freely. Upside volatility does the opposite. This asymmetry is one of the strongest pieces of evidence that the silver market is not operating as a neutral price discovery mechanism. It does not mean prices are fake. It means prices are conditional on stability, conditional on leverage tolerance, conditional on institutional risk limits. When those conditions are threatened, the system responds. Physical market participants are increasingly aware of this dynamic. Industrial users, mints, and refiners often operate on longer time horizons. They care less about daily price fluctuations and more about availability and reliability. When they see repeated disruptions or growing divergence between paper prices and physical conditions, they adjust behavior. This adjustment is subtle but important. It can take the form of higher premiums, longer-term supply contracts, stockpiling, or diversification of sourcing. None of these actions immediately change the future's price, but they alter the underlying supply-demand balance. Over time, these changes increase the pressure on the paper system. Investor behavior also shifts. Some investors move away from leveraged exposure and toward physical ownership. Others demand greater transparency or choose alternative markets. Each of these decisions is rational at the individual level, but collectively, they strain a system built on participation and confidence. Confidence is the glue that holds leveraged markets together. As long as participants believe that paper claims are interchangeable with physical reality, the system works. When that belief weakens, control mechanisms become more visible and more necessary. This is why discussions about silver often become polarized. One side focuses on charts, technicals, and short-term price action. The other focuses on structure, incentives, and long-term imbalances. Both are looking at the same market, but through very different lenses. The structural view does not predict precise prices or timing. It does not need to. It explains behavior. It explains why rallies are often sharp but short-lived. It explains why breakouts fail repeatedly. It explains why physical demand can surge without an immediate corresponding rise in futures prices. And it explains why, when adjustment finally comes, it tends to be abrupt and disorderly. The silver futures market is a machine designed for efficiency under normal conditions. Under stress, it prioritizes survival. Understanding this machine is essential for anyone trying to interpret price signals. Without this understanding, market behavior appears irrational or manipulated. With it, behavior appears constrained. In the next part, we will examine what happens when these constraints are pushed too far. We will look at physical market stress, inventory dynamics, and the conditions under which control mechanisms begin to fail, because no system, no matter how well designed, can suppress reality indefinitely. Part 3. When control meets. Reality, physical stress, inventory signals, and the endgame for silver. Every controlled system works. Until it doesn't, the silver market is no exception. Control mechanisms can delay outcomes, smooth volatility, and maintain confidence, but they cannot eliminate the underlying forces of supply and demand. Eventually, reality pushes back. And when it does, the signals are almost never found first in price charts. They appear in inventories, delivery behavior, and physical market stress. To understand where the silver market may be heading, we must shift focus away from futures prices and toward the physical layer beneath the paper structure. This is where the real constraints live. This is where the limits of control become visible. Physical silver is finite. It must be mined, refined, transported, stored, and delivered. Each step has costs, delays, and bottlenecks. Unlike paper contracts, physical silver cannot be created instantly to meet demand. When physical stress increases, the system has only two options: allow prices to rise enough to ration demand, or attempt to manage demand through non-price mechanisms. For most of the modern era, the system has chosen the second option. One of the most important indicators of physical stress is inventory behavior. Futures exchanges maintain registered and eligible inventories, metal that is approved for delivery, and metal that meets standards but is not currently earmarked for delivery. These inventories are often cited as proof that supply is ample, but inventory numbers alone are misleading. What matters is not how much silver exists in warehouses, but how much is available at current prices and under current conditions. Silver held in inventory is not automatically for sale. Much of it is owned by parties with no intention of delivering into futures contracts unless prices rise significantly. Some of it is held for industrial use. Some of it is strategic. Treating all inventory as equally available is a mistake. When delivery demand increases, inventories can decline rapidly. This has happened multiple times in recent years. Periods of heavy delivery requests are often met with drawdowns in registered inventory, reclassification of metal, or increased use of cash settlement mechanisms. These responses are not signs of abundance. They are signs of stress management. Another key signal is the behavior of premiums in the retail and wholesale physical markets. When futures prices are stable or suppressed, but physical premiums rise, it indicates a disconnect. Buyers are willing to pay more than the quoted price to obtain real metal. Sellers are unwilling to part with metal at paper prices. This divergence matters. In a truly free market, such divergence would be temporary. Higher premiums would attract supply, push up futures prices, and restore alignment. When divergence persists, it suggests that price signals are not doing their job. Industrial users of silver are particularly sensitive to availability. They do not care about narratives or market debates. They care about inputs. When supply becomes uncertain, they respond rationally by securing longer-term contracts, increasing inventory buffers, or passing costs downstream. These actions do not immediately show up in futures prices, but they tighten the physical market further. Over time, this creates a feedback loop. Tight physical supply increases premiums. Higher premiums signal stress. Stress increases the likelihood of delivery demand. Delivery demand pressures the paper system. This is how control mechanisms are tested. The silver market's reliance on confidence becomes its vulnerability. As long as participants believe that paper claims can always be converted into physical exposure at reasonable prices, the system holds. When that belief weakens, behavior changes. This change does not require panic, it only requires caution. A small shift in preferences, from paper to physical, from leverage to ownership, from short-term trading to long-term holding, can have outsized effects in a highly leveraged market. Because paper claims are so much larger than physical supply, even modest changes in behavior can strain the system. This is the paradox of control. The more leverage a system uses to suppress volatility, the more sensitive it becomes to changes in confidence. At some point, the cost of maintaining control rises, margin increases become more frequent, halts become more visible, rule changes become more common. Each intervention solves an immediate problem, but creates a longer-term one. Erosion of trust. Trust is not binary. It does not disappear overnight. It degrades gradually. Market participants begin to ask different questions. Not what is the price, but can I get delivery? Not what does the chart say, but what happens if stress increases? These questions signal a shift from speculative participation to risk awareness. History shows that markets do not break when everyone is euphoric. They break when assumptions quietly change. The silver market has already shown signs of this shift. Increased interest in physical ownership, growth in private storage solutions, and persistent retail shortages during periods of stable prices all point in the same direction. These are not anomalies. They are adaptations. From the system's perspective, this is manageable up to a point. As long as delivery demands remain within tolerable limits, as long as inventories can be shuffled, and as long as cash settlement remains acceptable, the machine can keep running. But machines do not adapt indefinitely. They have design limits. The endgame for silver does not require a dramatic collapse or a single explosive event. It could unfold as a slow recalibration. Futures prices may lag while physical prices lead. Premiums may become normalized rather than exceptional. Delivery constraints may become a routine feature rather than a rare occurrence. In such an environment, the quoted price becomes less relevant. It becomes a reference rather than a reality. Alternatively, adjustment could be abrupt. A sudden surge in delivery demand, a disruption in supply, or a loss of confidence in settlement mechanisms could force rapid repricing. In that scenario, control mechanisms may slow the move, but they cannot prevent it. This is where the concept of the kill switch reaches its limit. A kill switch can pause trading. It can raise margins. It can change rules. But it cannot create metal. It cannot eliminate demand. And it cannot restore confidence once lost. This does not mean that silver prices must explode higher. Markets are complex. Demand can change. Technology can reduce usage. Substitutes can emerge. But whatever outcome occurs, it will ultimately be determined by physical realities, not paper constructs. The most important takeaway is not a prediction. It is a framework. If you view the silver market as a free market governed primarily by supply and demand, its behavior will often seem confusing or manipulated. If you view it as a managed system designed to balance leverage, liquidity, and stability, its behavior becomes coherent. Managed does not mean fake. It means conditional. Prices are allowed to move within boundaries. When those boundaries are approached, controls engage. This is not unique to silver, but silver's characteristics make it especially visible. For investors and observers, this understanding changes the questions that matter. Instead of asking when silver will break out, the more useful question becomes, what signals indicate increasing physical stress? Instead of focusing on daily price action, attention shifts to inventories, premiums, and delivery patterns. Instead of reacting to headlines, one evaluates structure. This shift does not require abandoning paper markets or rejecting futures entirely. It requires recognizing their role and their limits. Silver's role in the global system is evolving. Industrial demand is rising. Monetary uncertainty persists. Supply growth is constrained. These forces do not guarantee any specific outcome, but they increase the importance of accurate price signals. If price signals remain distorted for too long, adjustment becomes more severe. This is the quiet risk embedded in control. The kill switch exists to preserve order, but order maintained at the expense of truth carries a cost. That cost accumulates invisibly until it must be paid. Whether that payment comes gradually or suddenly remains to be seen. What is clear is that the silver market is not behaving like a textbook free market. It is behaving like a system under management, understanding that reality does not tell you what to do. It tells you how to think. And in markets like silver, how you think matters far more than what you believe.